The current year was all about news and volatility. Elections, India and in US, multiple elections in Europe. The viewpoint which came from global central banks on inflation, how geopolitics moved in 2025. And that really added to extra element of volatility both for global financial markets. Net, even though news had its impact on volatility, it has been a good year for Indians. Wealth creation happened because of appreciation in real estate, because of gold, and because of equities. So how will 2025 be different from 2024? What will change and what will not change? And where the economy is likely to pivot? And can we really come back from the throes of this slowdown, what we've seen in the last 2 quarters? Let's take that conversation forward with Neelkanth Mishra of Axis Capital. Our viewers would recall that I've always said, is perhaps the foremost authority in terms of explaining, understanding, and then really dividing the construct of macro and connecting it with micro. So always a pleasure, Mr. Mishra, to have you on ET Now. Thank you for joining us.
Oh, thank you, Neelkanth. Thank you for those kind words, and always a pleasure talking to you.
India Strategy Outlook report, and I quite enjoy reading all your reports, and this one is indeed special because it's a report which really focuses on how 2025 will be different from 2024. So can you construct the big picture for our viewers?
Yes, so see, the biggest question in front of us is this slowdown that we just had with 5.4% growth in September quarter, really waking everyone up. Is this a sign that our trend growth is more like 5.5%, 6%, or should we persist with our view that the trend growth is 7%? And I think that there are enough reasons to believe that trend growth is at 7%. And now that the drivers of this slowdown, which was unintended fiscal and I would say credit tightening, not just monetary, but actually credit tightening. So as these start to reverse, I expect that GDP growth will come back to potential, which is closer to 7%. So we are projecting in FY26, 7% real growth for the economy, which is well above consensus. And the reasons are that in the first half of this year, the central government incurred only 29% of its full year fiscal deficit. On average, over the last 10 years, the median is about 62%. So there was 33% of the fiscal deficit, which should have been incurred but was not. Partly because of the slippages in May and June, when the government formation, the pace of government formation, elections were happening. As you know, this year the elections happened nearly a month after they used to be, and therefore there was a very slow start to the year. Given that the full year target is 4.9%, if you are slipping up on 1/3 of that, that's like 1.6% of GDP. Of fiscal tightening, which has happened just in the space of 6 months. That's incredibly tight. Secondly, on the credit side, credit growth slowed from 16.5%, 17% to more like 11%, 12%. That's again substantial level of tightening. This was caused by a shortage of money, so deposit creation was very slow. And then at the beginning of this fiscal year, the regulator became uncomfortable with the loan deposit ratios or credit deposit ratios in many of the large banks, and they asked them to slow down lending. That actually created a pretty vicious spiral. Both of these factors, as we see, are now reversing. So October, we saw the government bringing back spending in a big way. And I think the government machinery is out and out looking to meet its spending targets for the year. On the credit side, the cut in the CRR from 4.5 to 4 takes us back to the configuration which was actually delivering enough money in the pre-2022. And I think that as deposit growth, so remember that this is very high-powered money. So this 1.16 trillion rupees is not just 1.16 because this will go through a multiplier, and this means that over a period of time, this adds 5 to 6 trillion rupees to the economy. I think that will support credit growth. And if the central bank also eases some of the macroprudential measures it had taken to tighten, a lot of those were informal. I think that credit growth reviving should actually push us back to 7% in FY26.
Mr. Mishra, it's not for the first time we've experienced this combination of tight liquidity and slowdown in government spending. I'm sure it must have happened in 2014 and then 2019. What has been the experiences of the previous instances where because of election, the government spending had to slow down? It was not happened on purpose, but it happened because of compulsion. How much time does historically, how much time it has taken for economy to come back when government spending had slowed down because of election?
See, remember that the cycles used to be very different earlier. If you go back to 2009, we were just coming out of the COVID of the global financial crisis, and the government had actually given 80 to 100% hikes to all government employees. All of that flow was starting to happen. State governments were starting to implement the pay commission as well. If you recall, the government wage bill, general government wage bill, went up by 2.5% of GDP. So imagine, not just giving 100% hike, but also saying that for the rest of your life and your pensions, you'll be getting paid so much. That was a massive stimulus that we were running through as the elections happened. Around March was when global markets bottomed and the US was embarking on massive phases of QE and stimulation. So in a way, the election and the election-related uncertainty in spending, because salary hikes and 65,000 crores of farm loan waivers, there is enough of a stimulus for you to last through this phase of uncertainty. In 2014, if you recall, we were emerging out of the taper tantrum. So around September, the rupee had bottomed at about 68 to the dollar, and flows were starting to come back. And at that phase, the government was still doing fiscal tightening, but remember that the cycles there were much later. So the budget used to get presented a lot later, and the economy was used to that pattern of spending. This time, the budget was presented on the 1st of February, and the preparations were done on what the spending would be, but the elections happened nearly a month later. So if you recall, by 15th of May, earlier the results would be known and the government would be taking over. This time, this process was nearly a month later. So I think all put together and several of the distractions that happened because of the nature of the verdict, I think the pickup in government spending was much slower. But see, the fact is that versus 62% average over the last 10 years, we have seen a 29% in the first half, and that's factual. And unless we have serious concerns on the government's ability to meet its fiscal spending targets, remember that in October, what was that 33% gap has already narrowed to about 16-17%, because October, the fiscal deficit was way higher than what it used to be, and which means that the government is back looking at it. It's not surprising, therefore, that several indicators, like, say, power demand or auto registrations, there is now clear evidence that October was the bottom, and November onwards, the high-frequency indicators are starting to improve. The bigger question is this enough to take us back to 6.5, or more like 7% growth? And for that to happen, I think what we needed was the credit easing. And I think the first big step was this cut in the CRR ratio that we saw last year.
Okay. So if government spending will come back, will it come back in the same form, which is led by roads, defense, perhaps railways, or it could be different and different focus areas could be created this time?
So in the government, once or in any large organization, I mean, that includes, say large banks or all the firms that I've worked at, IT firms or consumer firms, once the budget is made, it's pretty much cast in stone, because in large organizations, you need to have that certainty, that flow, and those controls as well. And so The nature of spending this year is very much likely to be what was there in the budget. Frankly, what matters at this stage is the quantity of spending. See, there is a macro impact of the government's fiscal deficit, meaning that if the fiscal deficit goes up, it's a stimulus to growth. If a fiscal deficit goes down, it is a drag on growth. So at the first level, what matters is what is happening to the fiscal deficit. The nature of spending, are you distributing cash to people or are you building a road, affects the medium-term impact. So when you spend those rupees in road construction, the first year, that demand is created, people get jobs, material is acquired, machines are leased. The roads then keep affecting productivity and impact on growth for several years after that. Whereas if it was just consumption, there would be a bit of a multiplier, but then it kind of tapers off. So that we would see later. But I think the first step for the government has to be, and the priority has to be, just to get the spending off the ground. And I think the nature of spending will be mostly where the budgets were.
Now let's put your template into equity valuations and what should long-term investors do. The fact that economy has slowed down, some would argue that is yesterday's headline, not tomorrow's trend. Markets are forward-looking. So do you think investors should focus on economic recovery rather than slowdown?
Absolutely. And I think that therefore it is important when you're choosing your sectors to look at not just what has happened, but the nature of the growth. And in fact, how the nature of the growth can be very different going forward. And so when we are looking at markets, let me make three important points. The first is that this is an investment-led recovery. So the investment to GDP ratio is likely to be rising in the next 3 years, and which means that if GDP growth is 7%, investment growth, I'm talking real and volume terms, would be maybe 9-10% or at least 8-9%. And consumption growth, almost by formula, is simple arithmetic, would actually be slower, more like 4.5-5%. Within that, there is going to be a dichotomy. See, at this stage of growth in any economy, there is a surplus of labor, a shortage of capital, and therefore labor does not have pricing power, and therefore labor share of income falls and capital share of income goes up. As capital is generally owned by the top 10-20% of the population, this causes incomes to grow in a divergent way. So the 4.5-5% of overall consumption would actually be more like 3-3.5% for the low end of the population and maybe 8-9% for the top end of the population. So therefore, looking at FMCG companies and saying that, oh God, consumption is not happening, may not be fully appropriate. It may not be politically acceptable, but from an economic sustenance perspective, it may not be that important. That's the first point, that it is going to be an investment-led recovery, and I think there will be a greater income inequality unless there is significant amount of fiscal intervention, which at this stage, I don't think there is space for. The second big thing for the market has to be that after a period of several years where demand for equities was far in excess of supply, FY25 is the first year where supply of equities has actually overshot demand. And as we think about the next 12 months or even the next fiscal year, it is very clear that the supply of equities will remain in excess of demand. And that's an extremely important thing to keep in mind when we are projecting price to earnings multiple. The price to earnings multiple is also affected by the fact that in the US, the new regime whose mandate the people have voted them in to course correct, to disrupt. And so that means higher uncertainty, higher fiscal deficits, because I think the tax cuts are going to be the easiest thing to do for a president who controls both houses of legislature. And there is also going to be greater uncertainty on the currency side. So all of this means that the PE multiples may not really do that well. And the third element is what happens to earnings, meaning that if your economy is likely to do better than it was and sequentially pick up momentum, how does it translate into earnings? And especially as the capital share of income is going to rise, we expect that low teens growth in index EPS is very possible. I think the December quarter results will be quite bad. We will see more cuts. But as the pace of cuts slows down, as economic momentum starts to pick up, the roll forward gains, I think, will keep the headline indices quite supportive. So we would rather look for sectors where the earnings recovery or rather the earnings sustenance is going to be the strongest, and that remains financials and industrials. And we think that consumption as a whole will actually underperform on the earnings.
But just to take that last point of yours forward, that you expect that December, which is the current quarter, the current quarterly numbers will not be strong. It will warrant a downgrade. But are markets already factoring that in? The fact that this quarter would be a lukewarm quarter and we will see green shoots of recovery only from the next quarter, markets factoring in that template?
I think so. See, markets are like a giant neural network, and they are predictive engines. Individuals may have different opinions, but when it comes to the market as a whole, it is wired to be forward-looking, and it tends to be at least 2 to 3 months, maybe longer, ahead of economic trends. And therefore, what you saw in October, so there are occasionally, developments like what we saw in October, where the supply of equities was far, far, far in excess of the demand, and demand itself was really suppressed because of the high FII outflows. But with the exception of those kind of, issues which can distort the information signaling aspect of markets, I think markets are forward-looking. And my sense is that the weakness in December should be mostly known. But remember that till that is in the news, you see, like the weak second quarter number, frankly, I thought that the first quarter was also way weaker than what the CSO's estimates suggest, was something that we all expected and knew, and yet it has created so much of noise and concern. So it is occasionally better to let the information or the expectation become reality and then move on. And there could be some sense of caution, because remember that the response function of the market itself has changed, meaning how it responds to new information is very different from what it used to be, say, 10 years back, because the marginal buyer today is some small saver in a small town who's been advised by the bank branch manager that SIP is better than fixed deposit, and the information on that marginal investor responds to is very different from, say, if the marginal investor was an FII or a high net worth individual.
Mr. Mishra, now in your initial remarks you refer to two pockets: one, the government spending, and second is impact of monetary policy and credit CRR cut, how that will improve liquidity. So let's look at the other end of the spectrum. The Indian consumer, especially at the bottom of the pyramid, that has got hit, and stress is also visible in the way how companies or banks have reported their microfinance book. When do you see that end of the spectrum improving?
So, which is where again the macro growth going from 5.4 to say 6.5, 7, and then maybe a few decimal points higher is very important. Remember that if you were expecting a real growth of 7% and say average nominal growth of 10, 11, 12%, and then suddenly that growth slows to 7 or 8, then there will be at the fringes many borrowers who are surprised negatively on how much they expected. And then this is compounded by the fact that every single lender then pulls back at the same time. So you are stressed because the economy has slowed. But on top of that, as you know, bankruptcies happen because of lack of liquidity, very rarely because of lack of solvency, and just because of lack of solvency. But when all of this starts to happen at the same time, obviously the NPAs and the problems start emerging. Once growth starts to pick up, I think a lot of the healing starts to happen automatically. So the income growth for many of the borrowers on the fringe starts to improve, and therefore NPAs start to correct. So we have to view this from a top-down perspective as an economy which was growing at a certain momentum and then suddenly saw a blip because of fiscal and monetary happening and credit happening at the same time, and therefore it created negative shocks. Once the growth starts to resume, I think some of these stresses should fade. But let me say that on both these fronts, where the RBI was proactive, which is unsecured personal loans and microfinance, excesses were starting to happen, meaning that a very meaningful part of the MFI book today, microfinance book, consists of borrowers who borrowed from 2 or 3 or more lenders. These were things that were seen as warning signs in the last cycle, and it is actually quite concerning that they were allowed to happen again. Same on unsecured personal loans. I think the excesses were starting to happen, and those have been curtailed. But remember that the overall credit growth slowing from 16.5 to less than 12 is something that was well beyond that, and that's the one that we think can actually rebound from here. I don't think unsecured personal loans and MFI is likely to see stronger credit growth, at least for the next 6-9 months.
If you like this video, then like, share and subscribe to ET Now.